Hello guys, this is Daniel. I wanted to record this video of another pattern that I found. It's a pretty cool pattern, pretty cool, pretty easy. If you do this correctly, you should be getting a pretty good return through the end of the year. As you guys might know already, I don't like to be day trading, you know, 10, 20 trades a day. I'd rather just do 2 or 3 trades a week, very calculated trades. Then ultimately you get the same, pretty much the same or even better results. So this is pretty much the criteria. It could be any market cap, it could be any float, but this is the three most important items are these three right here. It needs to have gapped up at least 100% pre-market. The second one is that it needs to be extended less than 100% at market open. That's at 9:30 a.m. New York time. And the third criteria is that it has to have at least a pre-market volume of at least 10 million shares traded. So I pulled this out right here. I pulled this out from my master sheet. This is pretty much all of the trades, all of the stocks that meet this criteria. Now the reason you see a 70 here is because this 70 is what I have as my stop loss. You can put whatever you want your stop loss to be, if it's 50%, 60%, or whichever percent you want. So for me, it's 70. Now, if for all of this is all the data for 2003. If you see, I highlight all of the closing amount. We have a return of 390%. We have with 64 trades. So you would this particular pattern in 2003, 64 trades, 390% return. I think that's pretty good. In 2004, this data is from January to like mid-May. So if you highlight all of the closing for what's been happening for 2004, you would have it has a 203% return. This is assuming, of course, that you're shorting with the 45%, 45 count. That means with 45 trades, you make 203%. So you pretty much can combine this strategy with another strategy, and you can be making 500, 600, 700% throughout the year. So let me give you an example. Say this one. Let's get the first one right here. WLDS on 2/9/2003, February 9th, 2003. Let's go to the 15-minute. So as we said, the first requirement is it could be any market cap, any float. So that wouldn't matter. Market cap 16, float 4, but it doesn't matter. It doesn't matter. It could be anything. Gap up, it needs to be over 100%. So from here to here, this one barely made it 100%, almost exactly. It gapped up at least 100%. It could have gapped up more. So that's the first one. Extended less than 100% at market open, which is right around here, this line right here. It needs to be less than 100%. So we go from the prior day close. This is 100 right here. So it should open anything below that 100. So anywhere here is fine. Anywhere is fine, as long as it's below 100% extended. And then the third one, you would see this as the market right before the market opens, it should have at least 10 million shares traded for the day. So if you repeat this pattern over and over, you should be seeing a positive return. Once again, the reason why you see these 70s right here is because that is my stop loss, because you will have runners that just go out of control and continue, but you can adjust this to whatever you feel comfortable with. And if you repeat this over and over, you should have a good amount of return. And then this strategy plus a different strategy, you could easily make over 500 a year or 500% a year. Okay, guys, let me know if you have any questions. Thank you.